Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And in today's video, I'm going to talk about or address some concerns I've been seeing more and more in the comment section in my latest portfolio unveil videos, messages, posts. I've been seeing more and more things like my portfolio is too concentrated, too risky, too concentrated in the US, whatever you want to call it. Now that what you're looking at is basically my latest and greatest portfolio as of April 1st, April Fool's Day. Today I add a little bit to my HHIS position. So what I want to do is actually address these concerns and tell you my perspective of, you know, if I do have a risky portfolio, concentration risk. I'm going to give you my opinion on the risk of my portfolio. Let's actually break it down 100% together. So essentially, and for this video, I'm actually not including the small lira that I have left. My intention is still to sell it. Right now it's with MSTY. Let's not even count that. But when I do end up selling it and redeploying it into here, the main portfolio, it's going to be similar percentages. I'm probably going to be splitting up similar percentages. So right now, everyone, and this is probably my plan for the foreseeable future, I basically have $500,000 in a combination of HYLD and USCL. That's 31% of my portfolio. 500,000, same thing in QQCL, which is the Nasdaq 100 with covered calls and 25% leverage. All these funds have the same format, by the way, all 5 of these positions, covered calls and 25% leverage. More on that a little later. So I just want to do a full breakdown here of what my portfolio actually is. So you have 31% in that, in the S&P 500 ones, 31% in QQCL, 31% in HHIS, which has 14 stocks right now, and about 7% in MSTE, which is the MicroStrategy stock with covered calls and 25% leverage. Once again, that's my de facto Bitcoin position. So it's pretty much about 30, something like 30%. You know, how I'm visualizing it is 30% in the S&P, 30% in the Nasdaq 100, 30% in HHIS, about 8% is going to go in MSTE. Right now it's a little bit less than that, but keep in mind that strategy or MicroStrategy is part of the 14 stocks in HHIS, which is 31%. It's actually in the Nasdaq 100 too, but it's a very, very small. It's 0.5% of the Nasdaq or something like that. But I basically did the calculation, and it's basically about 6-7% of HHIS, which means it's almost like 2% is in MSTE. So basically, my Bitcoin or MSTE position, you could say, is about 6.86 plus 2. That almost makes about 10, right? So this is why I say I'm probably going to keep this at 10, because 2% is actually coming from HHIS. So 8 plus 2 equals 10, which is approximately right now the amount I want in Bitcoin exposure. So let's actually break it down real quick, guys. The S&P 500 positions, which make up 30% of the portfolios, HYLD and USCL. So these are so USCL is the easiest one to understand. It's literally the S&P 500 with 25% leverage and covered calls. HYLD is not exactly the S&P 500, but like it says here, if you actually, you know, compare it to the S&P, which we'll do, it's, I would say, more or less the S&P 500. It actually says it here, right? A higher yielding alternative to the S&P 500 with similar volatility. If you look at the sector mix, I pretty much consider it an S&P 500. Okay, guys. So what is the actual risk? Now, let's talk about risk, right? This video is about how risky is the portfolio. What is the risk of USCL and HYLD? Well, in my opinion, I'm pretty sure this is a well-educated opinion. The risk of USCL and HYLD is pretty much the same. Okay, not the same. Similar, very, very similar to just holding a Vanguard or BlackRock S&P 500 index fund. Why? Because covered calls lowers the volatility. Adding 25% leverage increases the volatility. They kind of cancel each other out. Not exactly. And that's why you actually have Hamilton on their website saying with similar volatility. And trust me, guys, I've talked to these fund managers. The amount of compliance and auditing and the fear that they have for the SEC in Canada is great. They're not going to put something that's a lie on their website. Trust me on that. Every word is viewed by their lawyers. So let's actually do a total return comparison, right, of USCL versus VFV. VFV is simply the Vanguard S&P 500 index fund. If you actually do a total return comparison, you could actually see, everyone, it's not rocket science here. Look at the graphs. First of all, you'll see that they follow each other extremely closely. That's because they have the same assets. So the performance since inception, USCL came out in July 2023. So from July 2023 until now, VFV is outperforming USCL a little bit. But if you actually change it to January 1st, 2024, you get a different story. USCL is pretty much on par or actually beating VFV with dividends reinvested and dividends not reinvested. So the reason, this is my personal opinion, I think when a covered call ETF, an ETF that uses options, is newer, it's not as big, it's not as liquid, it kind of struggles at the beginning. I've heard this from multiple fund managers. As the assets in AUM grow, it becomes a little bit more efficient with the options. They could do better with the options. So I think that's what happened, because it doesn't make sense from inception. It's not outperforming, but then, or it's underperforming. And then if you just change the date, the start date since January 1st, 2024, it is doing much, much better. So this is just to prove to you, I'm not saying USCL is going to outperform VFV. That's not my point. My point is that I expect it to be extremely close in terms of performance. And this is why I say that basically the risk of USCL to me is like owning an S&P 500 index fund. HYLD, same exact thing, except HYLD is Canadian currency hedged. USCL is not. That is really the major difference between USCL and HYLD, which means if the Canadian dollar gets weaker versus the US, that negatively impacts HYLD. It positively impacts USCL. This is why HYLD is underperforming USCL. But of course, the opposite is true. So if we compare HYLD to the the Vanguard S&P 500 Canadian hedged, right? We got to compare apples to apples, which is VSV. And I'm going to use the start date of February 1st, 2024, even though HYLD has been out for much longer than that, because HYLD, I'm not going to go through now, I actually talk about it in an upcoming video with Hamilton ETFs, HYLD 3-year anniversary video. Make sure to check that out if you own HYLD or thinking about owning it. But basically, HYLD became the HYLD we know now, the composition that we know now as of about February 1st, 2024. Let's do the comparison. Once again, you'll see that number one, the stock charts, the graphs are almost identical, right? And HYLD is slightly outperforming VSP for now. Again, I'm not claiming that HYLD over time will outperform VSP, and I'm not saying USCL over time will outperform VFV, although I think that's a pretty big possibility long term because of that leverage, and especially if interest rates stay low. But I digress. That's besides the point. I'm just trying to prove to you that these two positions, guys, HYLD and USCL, which I consider my S&P 500 position, the volatility, the risk, whatever you want to call it, is pretty much in line with just owning the index funds. And the same thing, by the way, applies for QQCL, which is another 31% of my position, right? QQCL is the NASDAQ 100 covered call ETF with 25% leverage. If we compare QQCL to QQC, which is literally the QQQ of Canada, QQC is basically just the NASDAQ 100 index. You'll see a similar story. Returns are the same. Volatility is very, very identical, if not almost the same. And QQCL, just like the other two, very pleasant surprise, is outperforming QQC. Again, I'm not saying it's going to continue in the future. I'm just trying to show you that the volatility, the risk, the performance is more or less in line with the index fund. So essentially, the risk of these two is the S&P 500. It's like owning an index fund. This is the NASDAQ 100. So before we move on to HHIS and MSTE, let's talk about what that actually means. What is the S&P 500? What's the risk of it? What is the NASDAQ 100? And what is the risk of it? The S&P 500 is the king of all kings when it comes to benchmarks. It's commonly referred to as the market, right? The US market, if you will. But basically, the S&P 500, a Standard & Poor's S&P 500, is a market cap weighted index of the 500 biggest and best, I guess you could say, companies domiciled or listed on the US stock market. That includes stocks listed on the trade on the New York Stock Exchange or Wall Street, and the Nasdaq index. Those are two separate. The Nasdaq exchange. Those are two separate exchanges, but this is top 500 companies in the U.S. basically. So you have the top companies here right now with the percentage. By the way, I'm just looking at XYLD, an S&P 500 covered call ETF, to show you the holdings here. You'll recognize and know all the companies, guys: Apple, Microsoft, Nvidia, Amazon, blah, 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 et cetera, et cetera, et cetera. If we look at the sector allocation, this is the ZSP ETF, which is an S&P 500 ETF from BMO. I'm just checking the ETF pages that have the nicest information here. You'll see the breakdown here. It's 30% technology stocks, but there's financials and healthcare in second and third place. Consumer discretionary, communication services, industrials, consumer staples, energy. Basically, all 11 sectors of the stock market, right? It's 11. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 are represented in the S&P 500, with technology being the highest sector. So to me, another thing you got to remember is that it's market cap weighted. So this is an index that's constantly going to be balancing out the companies to make the top companies, the top biggest companies will always be the biggest percentages. So I see the free market, when I think of a market cap weighted index like the S&P 500, to me it's the epitome of the free market, because whoever's biggest will have the biggest percentage, and if they start doing bad, they'll go lower in the index. So it's literally, in my opinion, one of the most perfect ways, basic, boring, easiest ways to invest in the overall market, the safest, lowest volatility way. You have instant diversification, you have instant auto balancing, and this is the reason why Warren Buffett says, there's many times he said this is probably the best way for the average person to invest on the stock market. You buy the S&P 500. If you don't want anything bad to happen to you, you buy the S&P 500. If you want a hedge against ignorance, you buy the S&P 500. So to me, buying and holding the S&P 500 for a long period of time is child's play. It's super low risk. I actually personally consider it zero risk. That's how I see it, right? Risk is really in the eye of the beholder. Volatility is mathematical risk. How do you calculate risk mathematically, right? So will the S&P 500 ever go to zero, guys? That would mean that all these 500 companies have to go to zero and go bankrupt. It's impossible, all right? The S&P 500 will never go to zero. Will it fluctuate? Yes, there will be some volatility, but it's the lowest form of volatility you could get, because it's a lot of companies, it's a lot of diversification. You have all the sectors. The index constantly changes. And the volatility, by the way, if we're talking about volatility, could be measured something called the VIX. The VIX is how volatile is the S&P 500. And of course, there's going to have some times where it's more volatile. But guys, it's never going to zero. So if you're a long-term investor, whether you hold a Vanguard or BlackRock index funds for the long term, whether you have the covered call version, whether you have the covered call leverage version like I do, it's all a form of the S&P 500. So to me, it doesn't even cross my mind that the S&P 500 is risky. I think that's ridiculous. So is it kind of concentrated in technology? Yeah, but 10 years ago, 15, 20 years ago, it wasn't, right? Because there wasn't as many technology companies. So this is why I say it's a perfect free market auto balancing mechanism. It's simply perfect, in my opinion. Another argument I hear is that, well, these are only U.S. companies, right? They're only U.S. companies. You have U.S. risk, U.S. concentration risk. I have to strongly disagree with this statement. These are international companies that have plants and manufacturing outside of the US that take in international revenues. To me, I'm not investing in the US. Okay, I'm not investing in the US government. Okay, a lot of people think, well, they're worried about the US government, the instability. Look, I'm not buying T-bills. I'm not buying US bonds. I'm buying pieces of the best businesses in the world, which are trading and domiciled in the US, but have international revenues and an international footprint. A lot of these do, right? That's how I see it. I'm also not investing in the USD currency. It's another argument I hear. Oh, what if the US currency collapses? I'm not investing in the USD currency, okay? I don't trade currencies. That's a whole other market. I'm investing in the businesses. So hopefully that argument makes sense. So to me, the S&P 500, if you cannot stomach the volatility of the S&P 500, guys, I think you got to reevaluate why, because to me it makes absolutely no sense. I think this is just child's play. Okay, moving on to the NASDAQ 100. So what is the NASDAQ 100? Top 100 stocks that are not financials listed on the NASDAQ exchange. So remember, there's the Wall Street, there's the New York exchange, there's a NASDAQ exchange. The S&P 500 includes both of those. The NASDAQ 100 only includes the one listed on the NASDAQ, which tend to be more innovation type companies, technology companies. And you have the top holdings here, and you'll see that there's a lot of overlap with the top holdings with the S&P 500, right? Apple, Microsoft, Nvidia, Amazon, Broadcom, Meta. These are all on the S&P 500 as well. But it's not just tech. If you actually look at the sector breakdown, I don't even know why financials is 0.45 here. I'm assuming it's a mistake. Maybe it should be 0. But either way, this is the sector breakdown versus the S&P 500. So 50% tech, but this is why the NASDAQ 100 is normally referred to as the tech index, but it's not all technology stocks. It's concentrated in technology because those are just the biggest and best companies in the world right now. But it also has some healthcare, industrials, materials, a little bit of materials, utilities, energy, financials, I guess, if that's right, some real estate, but there's a big chunk in consumer staples, which is basically Costco and Pepsi. They make up the top ones in terms of, there's Pepsi. But there's other stuff as well in there. Consumer discretionary, I guess Amazon would fall in there. Communication services, I think Meta and Google falls in there. I might be wrong about that, but either way, yes, it's a little bit more focused on technology, but I still don't see how. I still think it's child's play. Let me explain why. Just like the S&P 500, I actually see not much of a difference in terms of risk. For me personally, between the S&P 500 and the NASDAQ 100, when it comes to volatility, however, it is a little bit more volatile. So you know how the S&P has the VIX as a gauge to measure the volatility. NASDAQ has the same thing. It's called the VXN. So you see that it's 25.54 and the VIX, the S&P is 22.55. It's not that much higher volatility than the S&P 500. It has a lot of overlap. Yes, it's a little bit more volatile, but that just means higher yield, right? That's why QQCL is going to have a higher yield than USCL because it's a little bit more volatile, which means higher premiums, call premiums a little bit more. So you get an extra 1 or 2% yield here, right? But if you actually look mathematically between the two, since there's a lot of overlap, and I think there's going to be more, it's going to be more and more in line in the future. To me, it's not that much more risky than the S&P 500. It's definitely a little bit less diversified, but it's diverse. It's concentrated a little bit more in the tech stocks, which have done really, really well. So this is why the NASDAQ 100 index has beaten the S&P 500 over the last, 20 years. Let's do SPY versus QQQ, everyone. S&P 500 versus NASDAQ 100. And you could see that QQQ, the NASDAQ 100, has greatly outperformed, right? This is pretty much the tech stocks, right? And of course, the Magnificent Seven have outperformed the NASDAQ 100. The more concentrated you go, the more reward you could get. Hence the term higher risk, higher reward. But the NASDAQ 100, which includes the Magnificent Seven, is still diversified. Okay, you see that here. Yes, it is concentrated a little bit more in technology. Now, a big argument or an argument that I see is, Well, look what happened in 2000, the dot-com bubble, right? So in case you don't know, in 1999, 2000, 2001, there was a huge bubble on the NASDAQ because the internet was a brand new thing, and you could read all about it. No, dot-com bubble on Wikipedia. Basically, a lot of the NASDAQ 100 was completely different in 2000 than it is now. I read somewhere it was about 65% technology. Not now, it's 49, 50%. And it had a lot of startups and a lot of companies that went bankrupt, like pets.com, and there's a whole list. You could do research on it. There's a bunch of companies that went bankrupt, but I don't see that happening again, guys, because the NASDAQ 100 is not filled with speculative startups anymore. You have, over the last 20 years, it's pretty clear that now you have the dominant technology companies that are not considered startups. They're not considered speculative stocks anymore, because they've pretty much taken each their own corner of the market and dominated. And further proof to that, a lot of them have even started dividends. Apple has a dividend. Microsoft has a dividend. Nvidia even has a small one. I don't think Amazon has one. Broadcom does. Meta introduced a dividend. Costco has a dividend. Well, Costco's not a tech stock. Tesla doesn't have one. Google, I believe, has a small dividend now. So that's just more proof that these are no longer the same type of speculative startup stocks in 2000. Okay, these are well-established behemoths, and I personally look at them like staples. My opinion, these are staple. Everyone needs Apple and Microsoft and Nvidia now, Amazon. These are, to me, consumer staple stocks. I mean, everyone needs these companies now. That's just my opinion, guys, but I'm just trying to explain that this is not the same if you're thinking about, the dot-com bubble. I don't think that's ever going to happen again on the NASDAQ. The NASDAQ is much more robust now, more robust companies, even more diversification. I just wanted to share that with you because I know many of you think the NASDAQ 100 is so risky. I don't feel that way. I think it's a bunch of nonsense. I think it's pretty much just maybe a tad more volatile than the S&P 500, and the mathematical proof is in the pudding. Volatility of the S&P 22.62, 25.58. Nasdaq is always going to be maybe a little bit more volatile, but I think it'll calm down over time. It's not that much more volatile, which means it's not that much more risky, and that's why there's a crap load of overlap in the stocks between the S&P and the Nasdaq. But it is less stocks, more concentrated in tech, and it has resulted in higher volatility, but much higher reward over the last 10-15 years. And I think that trend will continue. I think AI and technology sector is going to be the most important sector, in my opinion, for humankind. It's not going to be banks and financials. I don't think so. Healthcare is important as well, but there's some healthcare in the NASDAQ 100. But I think you guys get my point now. I know I'm rambling on, but I think this video is important for me to share how I see the risk of my portfolio. So we've done basically about 60%. Think about it. 62% of my portfolio is in the NASDAQ and the S&P. To me, it's boring child's play, guys. I mean, now we're moving on to HHIS. So what is HHIS? It's the Harvest Diversified High Income Shares. So basically it combines a lot of the Harvest single stock covered call ETFs that are leveraged 25%. So if you go through the list here, here's HHIS. It's basically an all-in-one. And if we look at the latest press release, they said that as of March 31st, they're going to be adding all the new ones in HHIS. We'll take a look at all 14 companies in a second, guys. But here's a very important quote that will give us an indication of what HHIS is designed to do, what it's going to include in the future. HHIS is designed to include up to 15. Right now it's 14. Up to 15 Harvest Enhanced High Income Share ETFs. What are those? Those are the 25% leveraged single stock covered call ETF. So basically, HHIS will never have more than 15 stocks, 15 companies. And it's the latest inclusion will broaden portfolio diversification. So it's actually still diversified while continuing to support high monthly cash distribution. So the goal of HHIS is really to support high monthly cash distribution while being diversified. So what is actually in HHIS right now? The 14 companies are as follows, and they're pretty much equal weight. I don't know if it's going to be rebalanced. I think it will be rebalanced once in a while, but let's just say they start equal weight. Microsoft, Amazon, Meta, Google. These are not speculative, risky company, guys. Again, these are the top stocks on the S&P and NASDAQ 100 index. Microsoft, businesses need it. Amazon needs no introduction. I think it's the consumer discretionary of the whole world. Meta for your social media, etc., etc. Who knows what else they're doing. Google. You have the three biggest. I don't know if they're the three biggest, but I know Nvidia and Broadcom are definitely the top two chip makers, chip producers, which Google and Meta and Amazon and Microsoft are probably all going to need. Everyone's going to need those chips. So Nvidia, Broadcom, AMD for the chip makers. So yes, Microsoft is tech. Amazon, I think it's more of a consumer discretionary. Meta, is that communication? I'm not sure. I know Google, I think, is communication services. Nvidia, Broadcom, AMD for sure technology. You have Tesla, which is kind of seen as a car company. I see it more of a technology innovation company, not just cars. There's going to be robots in the future. Netflix, everyone has Netflix. Then you have things like Palantir, which is like AI software for businesses. So obviously it's maybe a little bit more risky than Microsoft or Amazon or Meta, but still a really big cap stock on the NASDAQ. Coinbase, which is a crypto exchange, the leading one in the world, the most official OG one. We know that BlackRock has partnered with them for custody. So I think Coinbase is really here to stay. Their strategy, which is aka or used to be MicroStrategy, which to me is basically like investing in Bitcoin, leverage Bitcoin. There's also Eli Lilly and Costco, pharmaceutical and a really boring, low volatile consumer staple company in Costco. So of course the yields on each one of these varies based on volatility. The ones with the high volatility will be things like Palantir, Coinbase Strategy. Things with a lower volatility will be things like Google, Meta, Microsoft. Costco is the lowest one. But hey, it's not just tech here either. I look at this HHIS kind of as a concentrated NASDAQ 100, except Eli Lilly. Eli Lilly is the only one in these 14 that's listed on the New York Stock Exchange. Everyone else is listed on the NASDAQ exchange. So it's kind of like almost a concentrated version of the NASDAQ. It's not 10 stocks. It's 14 now, probably going to be 15, because my hunch is that Harvest is going to launch a bunch of other single stock covered call ETFs. Maybe they'll launch Shopify or JP Morgan or ExxonMobil, Robinhood. There's all kinds of cool options you could launch. Another thing I love about HHIS is that the management fee out of all of these is actually the lowest. It's 40 basis points. This one's 85, this one's 65, 65, 40. So it's actually the smallest management fee out of all of them. Of course, I'm not talking about MER. MER are going to be about the same for all of them. The leverage costs, I believe, are going to be the same for Hamilton, Global X, and Harvest. I believe the cost of borrowing is approximately the same for these big institutions. So obviously the MERs are going to be, I think QQCL might have the highest MER because the management fee is the highest and the MER includes leverage costs and management fee. But I could be wrong. We'll see after a year. But anyway, small note on that. So HHIS, yes, it is 30% of my portfolio, but how risky is it? I don't see HHIS. I see it as a little bit more volatile and more risky than a QQCL, right? Because it's some of the biggest and core stocks in the S&P and the NASDAQ, but obviously it's more concentrated. So it is higher risk, but I could get higher reward, and the higher reward actually shows up in the yield. So of course, these writing call options on these individual stocks, especially like the high volatile ones like Tesla and Palantir and Coinbase and Strategy, you're going to get higher premiums than just writing it on the NASDAQ 100 index, hence the higher yield. And if these companies, I talked to Michael Kovacs, he wants big cap, innovation type companies poised for growth in the future. So if these companies grow faster, for example, than the NASDAQ 100, you could pretty much guarantee that HHIS will have better performance than QQCL, just like QQCL or the NASDAQ 100 has had better performance than the S&P 500. But either way, there's a lot of overlap here into big cap, quality stocks, growth stocks for the future here. So yes, HHIS a little bit more riskier, I would say, than the NASDAQ 100 for sure, because it's a little bit more concentrated. But hey, do you see any of these 14 stocks going to zero, guys, anytime soon? Maybe strategy could go to zero, I guess, if Bitcoin goes to zero, but I don't see that happening. So 31% in S&P, 31 in NASDAQ 100, 31 in HHIS. And HHIS, by the way, has the same format, right? Covered calls and 25% leverage. So the risk or volatility of HHIS is the same. I can't compare it to anything, but it would be very similar, if not identical, to an ETF that holds these 14 stocks equal weighted. That's basically the risk of HHIS. It's actually less risk than the Magnificent Seven, even though 6 of the Magnificent Seven are in HHIS. The only one that's not there is Apple. I'm assuming because Apple is really low volatility, they didn't put it, but I'm sure he'll launch an Apple one. But it's definitely less risk than the, for example, Magnificent Seven. We know that the Magnificent Seven has done really, really, really well. So, Costco's there, Eli Lilly. So you do have, yes, a lot of tech, but there's a lot of other stuff like Google and consumer like Amazon and Costco, Eli Lilly as well. So that's it for I would say my foundational 3. There's 4, but I look at HYLD and USCL as the same thing. So those are my 3 foundational positions. Now, I don't feel like this is risky at all, guys. I think obviously I'm going to get more volatility with HHIS, but I think over time it'll balance out and whatever. So last but not least is MSTE, which is actually one of the 14 in HHIS. And this is just my personal, the choice I made for my Bitcoin exposure. Why did I choose MicroStrategy with covered calls instead of, for example, Bitcoin with covered calls? Well, first of all, the format that I like is always covered calls and 25% leverage. But soon, there's going to be a Bitcoin with covered calls and 25% leverage ETFs coming out, I believe, from Harvest and Global X. So now there's only BTCY, but that has covered calls but no leverage. That's from Purpose. But I will still stick with MSTE, I believe, because MSTE is just like a leveraged version of Bitcoin. I mean, I'm investing in Bitcoin anyway, and I get rewarded with a massive, massive high yield. But I'm, for now, limiting it to approximately 10%. 110,000 right now. If I get it to 120, 125, it should be about 8%. Combine that with the 2% in HHIS, you're looking at 10. So for a lot of you, maybe 110, you say 120,000 in MSTE, that's super high risk. But you got to look at it in percentages, right? If someone has $10 million and they put $1 million in MSTE, you might be thinking $1 million. But for that person, it's just 10%. So I look at it in terms of percentage, guys. And to me, investing in strategy, I'm a huge Michael Saylor fan. All these guys do is buy Bitcoin. They're at 528,000 now. We know that there can only ever be 21 million Bitcoin. They already have more than 2.5% of the supply. I think by far this is definitely the riskiest thing in my portfolio, but I think it's probably going to have a crazy amount of reward within the next 10 years. If Bitcoin goes through the roof, MicroStrategy will even go more through the roof. And I think MicroStrategy or strategy will figure out a way to monetize for their shareholders all this Bitcoin has, all the Bitcoin they have. So this is why I like strategy versus just owning the Bitcoin. Who knows what they will be able to do, generate more yield and money by being kind of a Bitcoin bank. And I think now I think the days where people say, well, Bitcoin is extremely volatile. It is more volatile, but it's not as risky as it used to be 10, 20 years ago. I think it's now a legitimate new asset class. GameStop is buying it now, just like strategy. regulations are coming. The US government, I believe, is going to buy it. So this is all going to legitimize Bitcoin. Kind of reminds me of the dot-com bubble where, the cowboy era for tech stocks was in 2000s. Now we've matured. The cowboy era for crypto was maybe 5-10 years ago, right? Now it's also maturing, and a lot of these coins have gone bankrupt. But guess what? We know who the granddaddy is. We know who the king is. It's definitely Bitcoin by far, far, far. So I personally think, yes, Bitcoin, could it go to zero? Right? We're talking about risk in this video. The answer is yes, but I highly, highly doubt that now because there's more and more legitimacy to Bitcoin. So anyway, that's kind of a deep dive into the risk of my portfolio. To me, I could easily stomach this risk. For me, it's very, very easy to do so. I'm actually consider myself much less risky than 5 years ago when I had like 100 funds all over the place, crazy stuff, right? So to me, I'm very, very, very comfortable with the risk. You might not be. I am. Risk is in the eye of the beholder. But, once you break it all down and see what you're really investing in, I don't think it's that risky. Plus, I have the privilege of being an income investor where the focus is on the covered call premiums and the income. So I have an even additional layer of lowering my risk, because if, for example, someone replicates this portfolio in a growth fashion, so they have 31% in VFV, 30% in QQC, HHIS, I guess you could just buy the 30% in these 14, an equal weight of these 14 stocks, I guess you could say, and 10% in MicroStrategy stock. Well, it's going to generate very, very little to no income. So you're dependent, that portfolio would be dependent on the market going up over time, which it does. And I know it will, but it also depends on you selling it at some point because you have to sell it. I don't have that problem. So I'm much more comfortable with the volatility because I know in my heart I don't never have to sell these. I could just collect the income, pay my bills, reinvest as much as I can to average down. And as my goal is really to make the capital more or less even with my book cost. If I could, right now I'm down 10% because the S&P, NASDAQ, tech stocks have taken a hit. The biggest hit I've taken is obviously HHIS because it's more concentrated in tech. But if over time, over the years, I could limit this, or I can make sure I'm approximately broken even on my capital, just the capital, my annual return is basically going to be my income, going to be my yield, which is over 19% now. So I'm very, very comfortable and happy with this portfolio. I actually don't see why over the years I'll actually increase my risk instead of lowering. Maybe, because I don't have any kids to worry about as well. This is where this is personal things come into play here. If you want to leave your money to someone, I actually see myself taking a little bit more risk throughout the years, not less. So maybe concentrating even more in the NASDAQ and HHIS and reducing the S&P for that higher yield and reward and cash flow, right? Or increasing the Bitcoin exposure to 12% and 15%, right? So I might be doing that in the future to actually increasing my risk, yes, my volatility, yes, but my reward, yes. So it's just a matter of finding what best suits you. Give me a thumbs up. I'd really appreciate it, guys. I'm out of breath. I'm like sweating now, but I feel like this video is really important with all the changes I made. Many of you see it as, too much concentration risk, too risky. I don't see it that way. I see it as a pretty much Mickey Mouse portfolio. To me, I sleep really, really well at night, but hopefully this explanation was good for you. So I really appreciate your support and watching, guys. See you next time.